completely changes and your
Yeah.
exposure completely changes and your mark-to-market P&L goes up 20 million or down 20 million, you're not hedged at all when you thought you were hedged.
All right, everyone. Welcome to the Sophron Network, the podcast where we bring together people from the industry. For those who are interested in financial markets, we try to really bring on board traders, academics, and various people who are very active in the markets. Today we have Nikita Granger, Quant developer at Shell. He's working in algorithmic trading, energy markets, and structured derivatives. Nikita started as a data analyst at Priogen Energy, and then he moved to Shell, also as a data scientist, where he's building reinforcement learning models for gas and power trading, developed price forecasts across US and European markets, and then worked on derivatives linked to green certificates and flexible demand assets. Then he worked in deal structuring, and then now he's a quant developer where he builds trading algorithms around exotic structured products and power markets. So in this episode, we really wanted to break down how power markets function and differ from the regular markets that we usually cover, and then also how the pricing works in these products. We will dive into various things like Kirk's approximation, some hedging stuff, some physical settlement related things. So yeah, I'm really excited for this episode. My name is Vincent Brownsma. I started Amsterdam Investment Club and run Sophron, basically a network where we want to bring together everyone that's interested in financial markets. And I'm here today with Arnav Sate and Nikita. So Arnav, if you also want to do a short intro.
Yeah. Hey, Nikita, and to any of our new listeners. My name is Arnav Sate. I'm the founder of Prometheus Capital, which is a student-managed investment fund at the University of Amsterdam. I run the quantitative operations there. And Vincent asked me to be on this podcast to talk to some very exciting people like Nikita today, who's joined us and given us a bit of his time. So really looking forward to the podcast, and let's get into it.
Yeah, so I already hopped on a call with Nikita with some short intro where were calling for quite a bit, talking about various different topics in the markets. I think also in general, what we notice is that futures and just trading in the markets where a physical product is related to it is like completely different. So there's also different mechanics that you need to take into account. So I was already wondering, like regarding like a bit of the first question is you've seen like quite a bit from like data scientists to all the way developing like quant algorithms. So how did your path sort of go towards the energy market specifically? And maybe you can talk a bit more about your like the experience there and how that sort of came about.
Sure, yeah. No, I never really thought I would end up in working for an oil company. My dad and my grandfather both worked in oil, so I thought, well, I'm going a different, path. I'm studying. I knew I wanted to do something more like quant finance related. I really always liked exotic derivatives, but they became kind of outlawed, I guess, or very, very difficult to do in like banking. I thought that world was just gone essentially, but it's still very much alive in like the commodity space. In general, if there's any physical commodity in a deal, then like you're just exempt from Dodd-Frank. So that whole world of exotic derivatives is open to you. You can structure things however you want. You can get as like crazy or complicated as you want. And the only laws you really have to obey they're mostly like on the physical side, on like surrounding the actual commodity itself.
Mm-hmm.
But as far as how I got into this space, honestly, I think in general, students end up in whatever industry is really booming at that time. So this was around the time of like, electrification and EV, the whole electric vehicle boom. Cryptocurrency mining was getting really big. So, and there was a lot of deregulation in the power space. So it was just a new industry. They were hiring a lot of people. So I just ended up there, like you said, originally with Priogen, which is how I least partially paid my way through university working for them. And then, came over to Shell, where they really liked the fact that I had experience in power markets.
Is it
Um,
also like very like different than like equities and foreign exchange, for example? Is that like something where there's like certain key points? Because already on the phone we talked a bit about it. Like, what are some of like the core differences just for our listeners when you're trading like with futures for physical products?
well, I mean, the main difference really is, it's physical product. So you have to store it. I think that's one big difference is it's a very future, like basically you're exclusively transacting in futures products because it's much cheaper to store the commodity as a promise to deliver at some point in the future than it is to store it physically, right? Because if you buy at spot and a hold, then where are you going to put this, barrel of oil or whatever, right? So you need a storage facility, which is really expensive. So it's much easier to just be like, hey, I promise I'll deliver you this thing like a year from now.
Yeah.
So it's a very futures-driven market. Like I think I mentioned before, I don't actually know why you would buy a futures contract on like stuff.
Yeah.
I don't really, I don't know, maybe I'm just ignorant. I've never worked in that space, so I don't know. Maybe there is a valid reason to do it, but I personally never really got it. And commodities, if there wasn't a futures market, it would, it just wouldn't work. You'd have to physically store everything you produce. It just becomes, it's not realistic to operate in that manner. So it's absolutely crucial. So that's one big difference. I would say another thing that's also kind of weird and interesting about commodities is when you look really, really far out, a lot of things resemble options. They resemble like a gas plant, as you can think of it as like an option because you have the right but not the obligation to turn gas into electricity. So you're buying essentially a call option on the difference in price between gas and electricity, right? When you're looking really far out, you don't really know what the fundamentals look like. The market is very, you don't know what the supply and demand or the temperature or anything look like a year from now. So you just basically hedge your deltas, hedge your, betas, gammas, etc. And then once you get closer to delivery, it starts to become a lot more physical. So it has this interesting dynamic, I think, of like when you look really far out, it's much more financial. When you get to delivery, it looks a lot more physical. Whereas I think, like, at least when I understood the equity options and options on like fixed income or whatever, it's always financial. I don't think there really is a moment where it like changes to become, kind of a different skill set when you get closer to delivery. So that's something else I always thought was kind of interesting. And it's difficult to find somebody with the full knowledge of like everything, going from, just partial derivatives, looking really far out and differential equations and all that, and then when you get to delivery, you actually need to know like, okay, what are the laws around like, what I'm actually even allowed to do with this thing? What about this? Do we have to, like you might have signed a contract where like by law, the gas plant has to run 6 hours per day because you're calling in a bunch of people to physically run this, or like what if there's an accident, so they have to shut it, and it's the physical realities are very much there.
That's actually wild to think about how like a quant is sort of pricing them and then you're trading all of these instruments and then all of a sudden you have to think about like, where am I going to store the product? Because with equities, you don't really think about when you buy something that it's like it's not like a physical, like it is a piece of a company, but you don't really like get like a few walls and like one employee. Like you don't get that. So that's actually crazy to think about. I think that's also a bit of a bridge with how the constraints work. Arnav had a question about that.
Yeah, so the structure of power markets, you've sort of gone into it a bit already now. But if we were to now look at specific constraints, like, for example, storage limitations, transmission capacity, and grid stability, like shape price, how do they shape the price dynamics, for example?
I mean, I guess everything you said, the answer would be slightly different. So what I mean by that is, so from our perspective, the grid, like operating the grid isn't really our problem. It's the grid operator's problem. They have and that's handled very different depending on where in the world you are. So specifically in electricity, it's a very localized commodity, and just different regions have different ways of handling that. In Europe, the way they handle, like, well, when I say Europe, I mean specifically Netherlands, Belgium, Germany. Traditionally you have a control room that dispatches different generation, because you have to start worrying about not just the energy, but also things like alternating frequency. You in Europe is 50 hertz alternating frequency. If there's too much supply or too little demand on the market, alternating frequency goes above 50 hertz. If there's too much demand or too little supply, then it goes below 50 hertz. So in places like the Netherlands, they are trying to go towards this model of like no control room, where they want the market to be the control room, and you literally just respond to alternating frequency in real time. There's positives and negatives to that setup. It's not something that, like, so the negative to it is you don't know what the alternating frequency is going to be like. A lot of the, there's two ways of like handling it. One way is to directly respond in real time. If you're directly responding in real time, it's hard to really trade that on a futures market. It's very much something you just deal with on the spot. And the reason why I've never been a fan of that model is because, I guess it's more like, if you like the physics of things and combining the physics then it's kind of more interesting. But I never liked it, because if you're pricing a deal like a wind farm, you don't know how much energy you're really going to generate. So you have to take it then to this alternating frequency market, where you're most likely going to be paying a big penalty. And the question is always, what is that penalty? I don't know, because we have to take it to spot and then just hope that we resolve it well. We don't actually know, what the cost is going to be. Or even if you're a battery and you're on the opposite side, you could actually make money doing this frequency control stuff. You don't know how much you're going to get, because there's no futures market. So if you're building a battery, you want a loan, they ask you how much money do you think you're going to make? We don't know. We just have to a lot of times they just exclude that value completely from your economic valuation. From on the battery side, they just ignore it, because they're like, we can't put a number to it really. So that kind of, I think I'm not a huge fan of that. In the United States, the way it works pretty much exclusively is you have something called resource adequacy. So it's basically, you need to make a pool of reserves that the grid can use to dispatch. Essentially on your behalf. So when you go into so usually the two things that generate these deviations in alternating frequency are either renewable generation or customer demand. So if you procure any sort of renewable generation, or if you're selling to a customer, you have to procure some amount of reserve capacity that you then just hand over to the grid operator, and the grid operator dispatches everything. So the nice thing is you know exactly what the capacity cost is, because you have to pay that up front. So when you're signing the deal, you already know this is my cost of doing everything. So a lot of the physics is kind of abstracted away, especially the way so another thing that's, I guess, worth noting in a lot of modern power markets was that the market tries to abstract away a lot of the physics. It stops becoming your problem, and it starts just, like I said, it's abstracted away. And the problem with this is that sometimes the market accurately reflects the physics, other times it doesn't. Especially early on in California back in the late 90s, they had the whole energy crisis that Enron got really in trouble for. And that was because, in my opinion, a lot of the financial markets just were not reflecting the physical reality of things, and Enron and other players really heavily exploited that. They got a good price settlement for themselves, but at the kind of cost of causing blackouts and stuff. But they were just acting like I know they were indicted for crimes, but I don't think they actually did anything wrong. They didn't do nothing. They just were they were just doing what made sense, but it physically, I guess, didn't work out.
So as a quant, like how much of this stuff do you actually then, because when you're saying evaluating a deal, which of the stuff can you then already sort of take into account as a quant? Where does your sort of responsibility end?
I would say the grid responsibility, the grid stuff isn't really our issue. It's really it's really a question of like if we have a certain deal or a certain asset that's under our management, that's our problem. So we do have to take into account the physical constraints of our deal and our asset. The wider grid, it really only matters insofar as you can make money providing services to the grid.
Yeah.
So that could potentially be part of your business case. It can be very difficult to price though if there's no forwards curve for it. If there's no futures market, then who knows what it's actually worth,
Yeah.
right?
So what kind of deals, just shortly, like what kind of deals should you think about? Because you were mentioning like a wind farm, or like what kind of deals is it typically that you have to sort of evaluate as a quant?
Anything, whatever makes money, really. Yeah, some common ones we don't really own anything. My department of Shell, we in the Western United States, which is the area I operate in, we have no assets at all, like physically. We don't own anything.
Okay.
Everything is just leased, essentially. So the way you should think of the lease is if we're leasing, let's say, a pipeline, we're leasing an option, a call option on the difference in price between these two locations. So we can buy at location A, we can sell at location B. Sometimes there's several like exit points along the pipeline. So maybe there's like, you can buy at location A, you can sell at location B, C, D, E, or F, basically. And it's a spread option on all of those, essentially. So you think of it just as we're going long on an option, essentially. We pay a premium up front, and then we have a right, but not an obligation to exercise this option, essentially.
Okay.
So that's an example. We can lease transmission cables, so we can actually lease like a DC transmission line going from we have a bunch going from Washington to California. What else? Gas plants, batteries. You can lease the battery, lease the gas plant. We've leased hydroelectric dams. What else? We lease gas storage facilities. So those are just like underground caverns. You can you inject gas back into the gas field to store it, and then you can withdraw it from the gas field.
Really?
So you can lease.
Okay.
Yeah, you can lease like salt caverns and stuff like that, and then use them as gas storage facilities. And I mean, all this stuff are like options, essentially. Or like with LNG and crude, you can lease terminals. You can lease the whole or part of the port. And if you have like a large network of terminals, they're like a big spread option, essentially. So you can like buy at location A, sell at location B, and the bigger the network you have, the easier it is to make money. So that's why like large oil companies like playing in that space, because we're big and rich. So we can lease a lot of different ports across the world, and we can take advantage of all the stuff going down in the Gulf of in the Arab Gulf states and the Strait of Hormuz. We lost some capacity, port and terminal capacity in the Gulf, but we have a bunch in Canada, we have a bunch in Nigeria, so we can take advantage of the spreads there still.
Okay.
We don't lose completely, I guess. So it's that's kind of and that's also I think you brought up Kirk's briefly, Kirk's approximation.
Mm-hmm.
That's why, specifically for us, I'd say the workhorse in commodities is really spread options, because a lot of times you're either looking at moving the spread option moving the commodity across location. You're moving, in the case of the port terminals or transmission lines or pipelines, or you're looking at moving it across time, which is the case of the storage facilities, or you're looking at moving it across commodity, turning gas into electricity, turning crude oil into gasoline. A refinery gives you an option to do that, but not the obligation to. We think of all these things essentially as spread options. So you just have this big portfolio of different spread options essentially that you can manage. And it's all leased, or not all, but I would say maybe 95% of our business is just leases. If you look at Shell's LNG footprint, we barely own anything. I think we own, we're the largest LNG player in the world. We have 20% or something of the world's capacity. But almost all of that is leased. We don't actually own very much.
Yeah, so without these products, you would not be able to, it would be a complete mess, right? Having to trade gas around the world, it would not be possible almost, right? With all the storage and all the obligations and everything. like these instruments make it so much easier, right? So like just for the markets to function.
Yeah, well, I mean, instrument. Yeah, I mean, like the physical like infrastructure.
Yeah,
Essentially, yeah,
exactly.
you can't really financially buy gas in like Europe and sell it in America or vice versa.
Hmm.
You need a physical like LNG terminal to do that,
Yeah.
essentially.
Right,
Yeah.
Arno?
Then now that we've sort of talked about the gist of how you guys look at constraints and how you guys look at the dynamics when pricing options, and we kind of, Vincent and I and our listeners kind of have an understanding of how you guys try to price things. If we were to now go into like the structure of the energy derivatives itself, can you maybe talk a bit about what are exotic structured contracts in energy markets?
Sure. Yeah. So, what would be the best example? So like, for example, I mean, I can use the example of a gas plant because I think that's probably the easiest to conceptualize. With a gas plant, there's like, it depends on the market, but like, let's say if you're looking at a market like Texas, we have like basically two ways we can make money. We can either turn gas into electricity and generate energy, or alternatively, we can be like standby reserves in case there's like some sort of alternating frequency
Yeah.
issue. So from our perspective, the gas plant is, you can think of it as like a basket of spread options. So we can either run it like a gas plant, run it as like just turn the gas into electricity, or alternatively, we're a call option. Our gas plant is a call option on reserve services, essentially.
Okay.
And then we have an option on those options,
Okay.
basically. So it's a compound option. It's a compound on spread options between gas and electricity, and a call option on the ancillary services.
Okay, so why the second layer like on top? Why the option on the option?
Because you can change between them. So it's very difficult to price compound like, because at any moment you can say, okay, I don't want to provide, and I don't think of it in terms of like locking it in. Think of it as, I just built this gas plant. I can do whatever I want with it now, right? I can give it away and put it in reserve, or not, we'll sell it as like reserve capacity to the grid, or I can just produce energy and sell the energy directly, right? So you have the option to use it as a spread option, or you have the option to use it as a reserve service, essentially. So you have the option on those options.
Oh, okay, that makes sense. Yeah, so you're actually adding like a bunch of layers of sort of protection for yourself, so you kind of have that flexibility, right? If I understand correctly.
Yeah, you have, it gives you the flexibility to decide what you want to do with it, essentially.
Yeah.
So, and that's how we would model it. In practice, it's very difficult to model compound options. So I guess the correct way to do it would be, we would like have to actually just do a Monte Carlo simulation, right? And then basically evaluate like the option on the options. Practice, that's kind of difficult. If you also want to take like your Greeks, your partial derivatives, you would have to rerun the Monte Carlo simulation for every Greek you want to calculate. And keep in mind that our exposures aren't on one underlying; they're on a futures market. So that means every single delivery period has a separate delta. It has a separate vega. It has a separate gamma. So for one gas plant, you could be, and then you also have a delta, vega, gamma on the gas side, the power side, and then on the reserve services side, and then you have different delivery periods, right? So you could easily end up with like thousands or, of Greeks.
Yeah.
So if you have to re-simulate, let's say per turb one simulation, rerun the simulation, and just finite difference, it takes a really long time. There's some techniques where you can use, what's it called? It's that AI trick, automatic differentiation, where it gives you this like quasi like closed form solution. But sometimes it's like, if you have to do that through an optimization, it can be difficult to do it differentiation.
So what are the sort of like is it the same as like a regular, like for example, equity options, where like the volatility is like the most important for you guys, where for example, something happens in the world and then all of a sudden you have like shortages somewhere, or like what are the biggest challenges sort of in pricing these?
The biggest, well, so is the volatility the most important? So the biggest challenge, the biggest challenge I would say is parameterizing a lot of these things. So one is, I mean, compute time can be a big issue, actually. Sometimes it's just such a complicated product that actually calculating it correctly is difficult. So we have to take some shortcuts to do that. That can be one difficulty. The other difficulty is in parameterizing some of these things. So the spread option model we use, so Kirk's, one of the inputs is actually is correlation between gas and power. And you can observe things like the futures price from the futures market. You can observe implied volatility, but you can't really, there's no like implied correlation really. There's not like a spread option that's traded across gas and power on a market or on an exchange. So we don't really know what our correlation coefficient is. And you might think like, so we have to just estimate it somehow statistically usually. But, it's subjective, like if you're using a data set, do we use the last 10 days? Do we use the last month worth of data? You don't really know. And you might think there's not much of a difference between a 98% correlation and 99% correlation, but that could be like a $20 million swing in terms of the valuation of this derivative. Like it actually has a very big impact. It's very, and I would say the correlation is one thing that we've struggled with a lot. It's very opaque. It's very hard to tell.
Is there any way that could that sort of, do you think that will ever like go away? Do you think there will ever be like a market for that where it's easy to sort of see that? Or is it just something that you can't really make a market for?
I mean, you could in theory, but it's already so, like a lot of these markets are already so illiquid. So that's another big issue that we face is liquidity is a big problem. Because if you think about it, we have all these different like delivery periods, right? We also have different delivery locations. It's not like there's one gas market for the entire United States or the entirety of Europe, right? But there's different locations as well. And if you have to deal with all these different locations and then all these different delivery periods, they're not all going to be liquid. In fact, they're generally not liquid at all. It's very hard to find a counterparty. You might have some markets where there's an option transacted like once every month or something. So if you're calculating your implied volatility, and let's say you have an option or you have like, that's 60% just Vega exposure. It's an at the money, like we have a transmission cable that's at the money. Both ends of the cable are at the same price, right? The only thing that really drives the value at that point is volatility. If one side gets kicked into the money or the other side gets kicked into the money. And if there's only one option traded per month, then your implied vol is basically flat. Then an option trades, and then suddenly your implied vol completely changes, and your exposure completely changes, and your mark-to-market P&L goes up 20 million or down 20 million, and you're not hedged at all when you thought you were. That's another
crazy.
Big difference. Adding another layer where we start looking at spreads between commodities, we're already struggling with all the markets we have to deal with right now. I think that's like honestly just not that realistic. I don't think it's going to happen. No.
Fair enough, but I mean, like, how realistic would you say then is, for example, if you were to price the options for an equity, right? When you look at the options chain for any other sort of I'd say physical commodity, it's very much to do with you can very quantifiably derive the price points, or you can localize the maximas or minimas of an options chain for your advantage. Would you say that's something that's that's something that you can do with physical commodities, especially ones with energy that you deal with every day?
Yeah, I mean, like ultimately pricing the option is the same procedure, right? Like the value of an option is the cost of hedging it. It's the same for commodities. Like none of that changes. The procedure is exactly the same. The problem is more that a lot of these options a lot of these derivatives are very complicated. And there might be some, like I said, correlation coefficients and stuff that are just harder to observe. Also, liquidity in general for us is just a huge issue.
Yeah.
Like that's really one of the main problems. So I do like one of the things they do at work is we have this, we call it like a hedge simulator, where we literally just loop through historic data to see, okay, how quickly could I get my hedges on realistically in this market? And let's say after 6 months, I can only get my VAR down 60%. Then we need a big risk premium, you know? But what's a fair risk premium? We have some tricks based on VAR to calculate that. But like in general, it's more of a heuristic than it is like something you can, you know, really easily estimate.
Yeah, you can't really be confident when it's that illiquid. It's like just so unpredictable. Like you really don't know what to base it on.
Especially for like, that's been one of the hot topics now is data centers because of AI. And some of these data centers are just so big. The markets are so liquid that even like after 3 years, you still can't get rid of your VAR completely. You know, it's really, that's one of the main issues we have. And even just like trading, like you look at some of these order books and like on ICE, every trade that's ours, that shells is like highlighted in yellow. And you look at an order book and like half of it's yellow. You know what I mean? It's like, and then if one of our, you know, and then it's like if the one guy who puts these in is like on vacation, then it's like half of them are. And I mean, that's been the case like the last week. He's literally like our Canada traders on vacation, and then suddenly Canada disappears. You know, it's just like no markets. It's like, okay. Yeah.
This is like back in the day when like one person was quoting all the bids and asks, and they would be gone or on vacation. The board would be empty. Like.
No, it's very literally like that for a lot of our markets. So. Where a lot of it comes down to then like dirty hedging or proxy hedging, like because there's a few like really liquid markets. So in the US it'd be like Henry Hub gas. In Europe it's like TTF. The Dutch power market is like it's the most liquid product by far. You know, so if you want to hedge your Vega, you might, you know, even if it's like a power Vega in like Washington State, you still might sell like Henry Hub options against it. So you're selling gas options in Texas to hedge your power volatility exposure on the other side of the country. You know, it's kind of weird, but there's stuff like that you would have to do essentially in order to get rid of your VAR. Actually doing it on the market that you want might not be possible.
Yeah.
Or you do it by a portfolio. That's another option.
Yeah. You never write these. Like you never write them if they don't exist, right? That's not how you, or is that how you sort of do it when you're trying to hedge, or is that not how you sort of, do you ever like construct these products yourself, or you think, oh, you're missing something in the markets?
If there's something we're not confident on, it's just added to the risk premium.
Okay.
Basically. No, I mean, so we do. I mean, the way I see our role, like as Shell, is we're a risk warehouse. You know, I think like one of the differences between these large commodities traders and let's say hedge funds, like, I mean, Citadel or something, is we don't really focus on speculating on prices. We do that, but that's like the minority of our actual income. Most of it comes from just taking over risk for people. So if somebody wants to build a wind, you know, farm, but they need to get a loan for that wind farm, and the bank's not really going to give you a loan if you have no clue how much money you're going to make off of this. So what we can do is we can tie down the price risk. We can say, okay, we'll guarantee you X amount of money for whatever you generate, you know, so now that takes away risk from them. Or like someone's building a pipeline or a transmission cable. That's why that's the value, I guess, to the world in terms of us leasing things from them, is we take the risk away from them. Now they don't have to deal with the market risk. They can just deal with operating the asset. They can deal with, you know, and we take over all the financial risk. So we're like the risk warehouse. And, you know, like, that's not a bad thing, like in the sense that in Europe, I would say that the markets are generally better structured than they are in the US. I think they're a lot more sophisticated and the liquidity is a lot better there. But what that also means is that their margins are low. Like if it's easy to hedge your risks, then everyone can do it, right? If it's harder to hedge your risks, you can charge a bigger risk premium, and the advantage of that is that's your margin. If you can somehow resolve it, and like we have insane, like when I talk to our colleagues in Europe, we have insane margins here that they just don't have in Europe.
Okay, yeah.
Like we can make like a 30% return on a B2B electricity sale, where they're making like pennies, like nothing, right? Because it's so easy to hedge, it's worthless, Here it's much harder to hedge, like a data center deal. So you just take a 40% profit margin on it,
Yeah.
Like really, so you can make a lot of money, and that's like the cool thing about it. So it's not a bad thing if you can't hedge things. It's just you just need to charge them a risk premium.
Yeah. No,
okay. I mean, no, can I go, Vincent?
Yeah. Go for it.
Yeah. No, I was saying, so for a lot of our listeners who have not really looked into the domain that you sort of pertain to and that you work in, could you maybe give us walk us through a deal life cycle? What are the key stages? What does a deal look like for Shell, for example?
Sure. And I can also go through the different roles. I think of it like almost a conveyor belt of so usually we have somebody called the originator. The originator is the person who interacts with like the counterparties. So the deal could be literally anything. It could be B2B power or gas sale, or retail gas or power sale. It could be they found a transmission cable that's going for that. They're looking for someone to take over the risk, or there's a gas plant, or there's a pipeline, or whatever. They go out and they just have like a big network of people they know, and they have just knowledge of the market. They know where to look for these opportunities, and they bring in deals. They bring in customers. They bring in prospects. Then it goes into like the structuring quant team. So like my team, we in other companies, I've heard this role being called a quantitative strategist. I think that's a common term now. Basically, you kind of build the commercial strategy around this. Like, how are we going to monetize this? What are the different ways we can make money on it? Or, how are we going to hedge out the risk, like on a high level? And then you quantify all of that. You build out your model, and usually that involves like decomposing it into a bunch of like spreads, puts, calls, whatever, right? Spread options. So like in the case of the gas plant, you have that compound option on, your call option, and then on your spread option. So we price all that out. We kind of figure out roughly how are we going to hedge this? Can we use portfolio positions to hedge this? We have to go to the market. If we go to the market, usually you start talking to the trader. This is, and you negotiate with them kind of like, what's the risk premium you need to clear this, basically. Then if, let's say, everything goes ahead, everyone's happy, we're competitive, we sign the deal. We give them a good lease term, better than anyone else, right? They decide to sign with us. We now have this gas plant or whatever the infrastructure deal is. We take it onto our books. So the thing that's weird too about the way we do accounting is, unlike a hedge fund, since we're dealing with multi-year deals, a lot of times you pay the premium upfront day one, right? So if you look at if you do the accounting in an accrual way, so by that I mean if you look at year by year how much money we make, our first year is going to look terrible because we paid this premium upfront, and then the second year will look amazing because you have a free gas plant, right? So the way we do it is you have to look at the whole lifetime of the deal, and we value the whole lifetime of the deal every day, essentially. So we call this mark-to-market accounting. We look at the futures market and we revalue the whole option every single day.
Wow.
Basically, that's why the runtime is important. And we recalculate the grease, we recalculate everything. So we see, okay, what's the lifetime value of our gas plant, right? Including the cost we paid for it. And we see, okay, how does that value change with time? So what that means is you were responsible, even if there's a position in 2030, right? If that goes up, then the lifetime value of your gas plant might go up if it's power, or goes down if it's gas, right? We're still responsible for that. We have to take the whole item of the deal into account. That's another reason why the futures markets are so important. And why liquidity becomes a problem is, let's say the whole back of the curve shifts up, and that goes against us, right? If we can't hedge that, you could potentially be out like hundreds of millions of dollars, right? It's actually a big issue. So we have to take all that risk day one, basically. And that gets put into, so it then goes to the term trader who's they're kind of like portfolio managers. They basically they hold all these different deals. They hedge out the positions essentially, or they speculate if they feel like speculating. They could leave a certain delta position open if they feel like, oh, I want to be long that.
Yeah.
And then it goes from term. So term is, like I said, at that point, in the long term, it's very much still an option. And then, so you're mostly just like hedging deltas, hedging Vegas, hedging, it's hard to speculate on price like 5 years into the future. Who really knows, right? At that point, you're kind of more focused on just hedging out your risk. And then when you get into what we call cash, so cash month is kind of like, we call it cash because you're converting that mark to market value into actual cash. So when you get into the cash month, the actual delivery period, the delivery month, then it goes to a separate team called cash trading, and they typically deal with a much more short-term trading, and they have more of a view on the market. At that point, like, you don't have much theta bleed left because your time to expiration is very short. You don't have much Vega exposure because your time to expiration is very short. Everything is basically price driven. You have some idea of what the supply and demand dynamics look like, and those traders typically take a much more like fundamental supply demand, like physics driven view of the market.
Yeah.
And they can either put on hedges, take off hedges, maybe leave some exposures open. And then finally, at the very end, it gets passed to our real-time desk, in the case of power, to our scheduling desk. And they actually operate, they interface with the grid. They actually go directly to the grid operator. If something goes offline, if there's like an outage, they have to inform the grid operator. And these people operate 24/7. So there's always somebody at the office every minute of every second of every day, because you need somebody to talk to the grid operator. They work, at least here, they work in 12-hour shifts, 3 days a week, essentially. And that's
so
kind of
cool.
the end of the line, pretty much.
Yeah.
And where, like, I guess quants really fit in, the two roles that quants play is in structuring and setting up the deal. And the second thing is in hedging. So like I said, if we're doing like a dirty hedge, then, for example, how many gas options do I have to short to that, in order to offset my power Vega? Like, what's the ratio of gas Vega to power Vega? And you would do that calculation. You would calculate the hedge ratios. Like, maybe you say, okay, I need to short twice as many gas options to get to my power exposure down to zero, because that's just how the correlation coefficients work out. Because like I said, all mark to market. So you want to see mark to market, like how do the futures markets move against each other?
Yeah.
So that could be another role, is in structuring and building out these like hedging strategies and doing all the math to calculate like, what do I hedge with what? Where are the correlations? How confident are, and yeah, those are the two main roles for a quant typically.
Yeah. So the hedging that you do is super dynamic, right? In that sense, because you're basically like trying to hedge every single time.
Unless it's portfolio, like sometimes they just offset themselves. You have a clean portfolio hedge, but otherwise you just have your deltas and Vegas and gammas and whatever, and they just shift around. Yes, you have to kind of rebalance regularly.
So how do you then come to the final conclusion of we made X amount of money on this deal? Like, how do you then with that sort of, is that the cash department?
Usually you'd have to, yeah, I mean, that's actually an issue. It's kind of hard to tell. No, and I mean, this is like, this is why companies like Exxon and Chevron like basically refuse to do commodities trading at all. It might sound weird that a commodities producer would refuse to trade, but it's actually really hard to tell if your trade desk is making money, especially if you're dealing with assets that other people develop, because some part of that money has to be like given in your financial statements to, let's say, like the team that actually developed the oil field, and then some goes to the traders, and the traders get bonus based on their contribution. but the engineers and the geologists don't get bonus based on their contribution. They just make whatever they make. So there is kind of this perverse incentive. So it is hard to tell because you're not just competing against, because you're not just like looking at trading, you're also looking at like, or a transmission cable will make money just on its own. You don't really need to be a smart trader to do that. So how much money did the transmission cable make versus how much money did the actual trade, how much value did the trade desk add? It's actually not easy to tell. And then on top of that, like you said, you have mark-to-market accounting. You pay up front, and then you have this kind of sometimes hard to tell what the future value of this deal is. On top of that, another really big issue that we've been facing as an industry is futures markets have an issue where, because like the cost of a futures contract isn't really, because like I said, the cost of storing a commodity is expensive, but a futures contract also has a cost, and that is how much can you trust this person's word? You told me you're going to give me X amount of barrels of oil 10 years from now, but will you even be around 10 years from now? Do you actually have that oil 10 years from now? So what everyone does is they have to put down collateral at the exchange. So they call this like a margin. Maybe you've heard the expression margin call. You put down collateral at the exchange. And in like 2022 in Europe, power became so expensive because risk went through the roof. So people maybe in the past had like $5 million or euros at the exchange, and then suddenly they were being asked, well, actually market risk went up, so you have to put down more collateral. So actually that instead of 5, you have to put down 50. And although, the smaller players just didn't have that money, so they were just forced out of the market. They're like, okay, close up your position, leave. So now they can't participate in the market anymore. And more trading then becomes concentrated in the hands of fewer and fewer people like Shell, right?
Yeah, like the whole yellow order book.
Well, you become too big to fail. So now they're like terrified. What if Shell defaults and we're like 40% of the market? Then we have to put down even more collateral in case that happens. So suddenly we have $6 billion sitting at the exchange. We paid $1 billion up front for this gas deal. And we think maybe across the lifetime, we might be able to make, 500 million or, in profit. But who knows? Like you have this money sitting at the exchange earning nothing, no interest. You have this upfront premium, and it's all based on some sort of projected future returns on a market that's actually very illiquid, and you can't really see it. Transaction.
That's crazy.
It's actually pretty opaque. That's one of the issues that we face as an industry.
But then again, it's also something where it's like, what do you kind of want to happen? Like, do you want to go towards like a European market where it's more efficient, but then the margins become thinner, and then obviously that's also something that's like maybe more beneficial, but then like, is there actually a market for it if you're already like 40% theoretically of the market? So that's also like an issue, right?
No, it's no, that's correct. So those are basically some of the issues that we face. And like I said, I don't blame people for not wanting to get into this industry. Even if you think it might be very natural for like Exxon to do more trading, they just say, well, no, we don't like it. Which
no, it's super interesting how like actually the conveyor belt sort of different divisions like cooperate to put this deal into motion and then like hedging all the risks. I never thought about it that way. Like, how about you, Arnav? Like for me, it's like completely new.
Yeah, it was new to me as well, because then we look at generally how a trading desk would like structure a deal, right? It doesn't have that many participants really. It very much is like essentially a team huddle that goes into a discussion. We action an idea and then it goes through. But here it's like actually a proper deal.
Yeah, the way I describe it is commodities trading, at least the way like Shell and BP and Vitol, Trafigura, these people, these players do it. It's more like banking was before 2008, like back when anybody could write any sort of option on anything. That's kind of how we operate more. Like I said, if there's any physical commodity associated with the deal, then we don't have to go to like the ECB or the Federal Reserve and get approval for our model and get our stress test. we can do what we want. So yeah, that's the way I think of it, because I think sometimes people think we're just like gambling on markets, and to some extent we do, but there's just not very much money in that. There's a lot more if you have like a 30-year lease on a LNG terminal. You can make hundreds of millions or billions off of that. Gambling, price direction. If you do well, you might make a couple million.
No, so that's why it's like a risk warehouse, like you were saying, because that's way more important. Like you're actually looking at that way more. Yeah. No, that's super interesting. Also wanted to very shortly some rapid fire, because you also said something about honey futures that you were trading. Any other markets where other markets where you say those are like something that you wouldn't really think of otherwise?
I can talk about the honey futures thing. So me and a guy who like runs a bunch of meaderies in California, he like we think there's a good market niche for futures contracts in honey. So right now the way honey works is it's very it's a different commodity, but the problem is kind of the same essentially. In this case, our deal is a forwards contract. Essentially. Like I said, the issue with the forwards contract is we have to take care of a credit risk. Like, okay, I can promise person X will deliver to person Y, but they have to put down some collateral or something. And managing that is really like, I guess what we're looking at, managing the credit risk. The issue with bees and honey is that it's a very high risk business. They have what's called like colony collapse. If anybody's familiar with that, at least I've heard of it before I met anybody in the honey industry.
Never.
But bees have like a very, I mean, I might be wrong on this, so I apologize if there's any like insect experts.
I don't know if they're listening.
They have a very centralized reproductive structure. The queen bee like lays all the eggs. And if the queen bee for some reason is just not feeling it, the whole colony's dead.
That I've heard.
That's kind of a disaster because you're out of colony. And the issue, and this is also an issue in Europe, in generally in high cost regions, they don't really make money off of honey production because it's too expensive. It's cheaper just to import it from a cheaper country, a lower cost country. So the way beekeepers mostly make their money is off of pollination services. And what they will do is they'll literally take a beehive, they'll throw it in like a back of a truck, and then they'll drive over to your field and they'll just let loose the bees to pollinate, I guess. That's like where they make maybe 80% of their income. The problem is like bees aren't meant to live in a truck, so it's stressful. And they have a very centralized reproductive structure, like I said. And if the queen bee isn't feeling it, then no babies, no eggs, and then the colony just kind of disappears and dies. And about like 30 to 40% of colonies fail in a given year, which is quite catastrophic. Like it's a very high default rate. So the way this was handled was through storage. They would physically store the honey. That way you don't have to worry about credit. You just deliver what you have, we'll put it away for you. And then we'll just, we don't have to worry about like how many bees die or whatever. And we think that's kind of lazy. Like there is a role for storage, but I don't think it should be in the place of the futures market, And it's a very expensive way to do things because you need the storage is expensive. The other issue as well is there's different blends of honey. Oil has the same issue, by the way, is there's different grades of oil that are more or less valuable, right? Depending on what products you get when you refine it. So some oil produces more, gasoline, diesel, kerosene. Those are really the three most valuable things. Other oil is very heavy and produces a ton of like just tar or like waxes, and that's a lot less valuable, so it becomes worth less. And the issue is in a storage facility, since they're expensive, you might not be able to store all the different types of honey or the different types of oil separately. You have to blend them and throw them all in one vat. And if you might have some super expensive blend of honey, some bioorganic, I don't know, cauliflower, sunny dew, whatever.
They just throw them all the
That might sell for like $5 per pound, but then you have some really cheap, crappy, like mass-produced, whatever, conventional honey that sells for $1.60 per pound.
Yeah.
You mix it, right? Because we don't have enough storage facilities. Everything sells for $1.60.
Yeah.
It doesn't matter what blend of honey you have. So that was kind of the vision, is if we could do more on the futures market.
Yeah.
And I guess where the innovation on our side was really around managing the credit risk and how to take care of that side of things.
No, that's super
without
interesting.
making it too expensive. But yeah, so that the plan is going live shortly. We have the contract drawn up. We have like more or less the structure. It's just a matter of there's the pilot it in the next I'm hoping in the next few months we can actually go to a beekeeper, try to transact this to see end to end. How does it work? How does it look? Where does what did we miss anything? And and try to make run a forwards market. And like I said, the cool thing too is that since it's an OTC contract with a physical commodity to it, we're not subject to any regulations other than the ones on the honey. If you think about it, it's just like you're pre-ordering honey effectively. It's not subject to Dodd-Frank or whatever, It's we're kind of free to do what we want.
No, but that's super cool how you're actually as a quant making impact through taking away risks or making it easier for certain beekeepers. That's super cool.
That is right.
I'm hoping we can bring down the cost and that we can make also just honey production itself a more of the focus of beekeeping, rather than pollination, because that'll also bring down stress on the bees. And this is something I wanted to point out. One thing that I like about commodities, and I don't want to be disparaging to anybody. I have a lot of friends who work in high frequency trading or at hedge funds, but realistically speaking, if a lot of these companies disappeared, or for example, let's say futures contracts on S&P 500 disappear tomorrow, who gives a shit? You know what I mean? Stuff doesn't really matter. And I mean, but if futures in commodities disappear, or if players like Shell disappear, that would have very, very, very real consequences to your day-to-day life. And that's actually something that I like. I know maybe people don't usually get into quantitative finance or trading to help the world or whatever, but it's kind of cool how this has a very, very real consequence. And if you do your job well, it really means that your electricity bill becomes cheaper. It means this wind farm is now profitable, so we can build more, or we de-risked it enough to where now people are willing to invest in this stuff.
Yeah.
Or, you know what I mean? It can have a huge consequence. And, or even if you're just market making, if you're just injecting liquidity into these very illiquid commodities markets, well, now it's easier to what your risks are better. You can mark your risks better, and you can also get rid of your risks better. So that means you charge less of a risk premium, so your electricity bill becomes cheaper.
Yes.
And I think that's kind of cool how it has very real meaning to real people. And even if you don't care about finance, this still impacts you. Whereas, like I said, if you look at market making S&P 500 options,
so
again,
if me and Arnav
disparaging.
If me and Arnav go to the grocery store and we see next year or the year after that honey is cheaper, we're thank you. They kick us.
We have you to thank. You to thank.
If we can, I mean, seriously, that's actually kind of the vision of this.
That would be so cool.
So I'm hoping we can do something there.
But what is your biggest, I think now, because you're sort of the first quant that we've had on this podcast, and Vincent and I have done together, I think 5 or 6 episodes now. And you're the first out of, I guess, the 7 people that we've had thus far who've actually used some of their skills to try and, for the lack of a better term, or maybe it is what it is, to make the world a better place. What is something that you can say? Is that sort of a byproduct of just who you are, or is that something that you've actively tried to do since you were at the UVA, much like me and Vincent?
I mean, honestly, I think it's just a consequence of like commodities have a very real impact on people. You know, it's a very tangible. Like honestly, a lot of finance got started because of commodities. You know, because you needed a futures contract for commodities. It just makes sense, like logically. So we needed to build that framework early on. We needed to build those legal contracts. We needed to figure out how to deal with credit risk, you know? And honestly, I think it's just built into the industry. Like in that sense, I think because I don't think that people working in high frequency trading or something just don't care about society. I just don't really know how that impacts society, you know, that much. And even like the whole liquidity, like the weird thing is I'm in a ton of illiquid markets, and I'm talking to some of my, like I have some good friends who work in high frequency, whose like full-time job is just liquidity provision. That's like all they do. And I'm like, well, why don't you participate in our markets? You know, there's a lot of opportunities for it would really help us out. And they're like, oh, there's too little liquidity there.
Yeah.
They only can really seem to participate in markets that are already really liquid and don't really need them.
So they create more liquidity when there's already liquidity.
Yeah, no, and I understand how a lot of the liquidity provision algorithms work, but it's very like you need to get out of you need to be able to get out of your position really quickly, and if you can only do that if the market's already liquid, and if the market is hyper illiquid, then you're just taking so much risk. You know, it doesn't make sense for them, and I get it, but you know, I don't think it's like a lack of will or desire. I think it's just the nature of like my industry. It has a very real impact on people, and if we do a good job, like for example, if I can charge less of a risk premium to this wind farm and an offtake, I can offer them a better price. I mean, I have to because other people are competing for the same offtake agreement, right?
Yeah.
So the winner is whoever offers them the best price. So if I do my job well, naturally will, you know, enable more projects. Like good things will happen for society. It's not like I necessarily even choose it to happen. It's just the consequence of the work, you know? So I guess that's my very long-winded answer to your question. It's just inherent in the commodity space. It has a very real impact on people. And if you do a good job, it will translate to lower prices. It will translate to more infrastructure being built. It will translate to, you know, like very real tangible things.
Yeah. So it's really like a byproduct of your work.
Yeah. No, I mean, like I didn't really go into the honey thing. Like, I mean, like obviously I'm hoping to make money on this. But you know, I will make money on it if I do a good job.
Yeah.
You know, if I can find a way, and like we think we have some innovative ways to basically bring our credit risk down to like almost zero. That won't get huge costs to the beekeepers as well. Like we won't rely on, you know, like these like on what they call initial margin. So on putting down collateral, which is really expensive, and a lot of farmers just don't have collateral to put down, you know. So how do we resolve that credit risk without them putting, you know, and we have, I think, creative, innovative ways of doing that, you know, for our futures contract, and that'll reduce the credit risk, which will make the futures market viable. We don't have to resort to storage. We don't have to blend, you know, different types of honey together anymore, because I mean, you can have infinitely many forwards contracts, right?
Yeah.
For your whatever weird, unique blend of honey you have, you can make a futures contract with it.
Yeah.
You know, stuff like that is, you know, and like I said, if I do a good job, that'll mean the beekeepers can make more money. They'll be just larger, and it'll also bring down the cost for consumers. And
it's better for the bees, like you said, so that's also good. So no, I really like it. Like I think that's also like something that like this entire story, I think it's really cool, because you're basically going from like data scientist to quant, and then using your skills for like real world problem solving and like products that are actually impacting people's lives. I think that's super cool.
No,
so
you know, finance has I think sometimes people get too focused on like the gambling side of things, but like there's very real consequences to a badly run financial system. You know, like it really hurts people if you do a bad job. And I think sometimes that message is lost. I think people get too lost in like the mythology of Wolf of Wall Street and stuff. And I mean, it exists, it's there, but like yeah, it's real, and I think people need to, it's something that people should take seriously.
Yeah. No, I also think that. But thank you so much also for your time today to like share all these insights. I think from my side, it was a lot of new things and also
Yeah.
super interesting. Anything you still want to say, Arnav?
No, just that I learned a lot. I didn't know a lot about energy trading. Didn't know how deal structured work or how you guys were essentially a risk warehouse over at Shell. That was something super interesting
Yeah.
that I learned for the first time today. And I hope that down the line we get to have a more open conversation regarding these kind of things. Super interested in that. I really want to do a part 2 for this episode to see how the B project goes.
Yeah,
maybe next year.
Yeah.
That'd be cool. I'd like that.
Yeah,
would be easy.
absolutely.
And then like maybe like one in Amsterdam, like an actual like physical podcast
Yeah.
with some
Yeah. Sure. No, I go back a few times a year.
Yeah.
I'll let you guys know next time I'm around.
Yeah, but
Absolutely.
like something with what's nice with honey in it, like with cheaper honey. That would be nice.
Yeah.